Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger, and we are here for another ISE webinar. I'm the Director of Education at the ISE, and we give webinars, one or two a week, where we bring in special guests. And today, I'm pleased that we have Jack Crooks with us. Jack's going to be talking about China's conflicting relationship with the U.S. dollar, and Jack's been with us many times throughout 2009, and he alerted us to the weakness or the potential weakness way back when of the euro and the problems with Greece, and of course now that's all we read about. But Jack has some other ideas today, what's going on in China, and he'll talk a little bit about what's going on in Europe. So without further ado, I want to introduce Jack Crooks. Jack, how are you?
Hi, Steve. Fine. Thanks for having me. I appreciate it.
Thank you. Thanks for joining us. So I just gave you controls. What you can do now is go to share. Yep, perfect.
Got it? Okay. Great. Can you see that okay?
Great. Yep, perfect. Thanks,
okay.
Jack.
Sure. Let me grab the pointer here. Thank you, everybody, for attending. I very much appreciate it. Thank you again to the ISE for giving this opportunity to share some thoughts with you. I'm going to go through the presentation and hopefully get through it fairly quickly. I have a lot of slides here, but some for you to just view and maybe view at a later date in more detail. We're going to try and I'm going to move through those pretty quickly and try and get to your questions. I think you guys have some really great questions, and I think sometimes that's the best part of it, at least for me, is trying to handle some of your great questions. So I'll move through this, and then once I get through it, I'll get back, circle back to the questions, and if you can think of something along the way, just feel free and fire it out there. Needless to say, we follow China pretty closely, but then again, everybody does now. So it's a big driver, really, not only of currencies, but really of every other asset class, and it's a very odd relationship, a very odd symbiotic relationship that is subject to change in the future, and it's subject to change that will change. I think has the potential to be very, very nasty if the change comes about the wrong way, but very, very good in terms of rebalancing the global economy if change comes about the right way. But needless to say, given the fact that China looks like it's going to continue on a secular growth pattern, this change will happen. I'm going to go through really some of the growth drivers that are really enhancing the wealth of China very, very quickly. Won't spend a lot of time there, and then get into some of the risk in the market right here, and some of the reasons why China's change in currency policy can benefit them in a big way. I actually spoke in Beijing about a year and a half ago at a currency conference, and they had some bigwigs there. The guy was like number 2 in SAFE, State Agents in Foreign Exchange. They managed, I don't know, $800 billion or something like that, give or take $100 billion here or there. And they had the guy who was the head of the banking regulatory system. And it was a very interesting conference in that they didn't really give a damn about anything that I said. But I talked about this symbiotic relationship potentially breaking down given the move of the U.S., at least politically, moving from a capital to a labor, and you think of just swings and in cycles, that tends to swing in cycles. You move from a kind of a labor dominance from a political outlook to capital, and you get overextended, and then you start to swing back. And a couple of years ago, we in our research started to see this swing back towards labor, and because of that, it's created some increased tensions, and really not much has changed in the last couple of years. We thought the credit crunch was going to be a problem, and China is dealing with it, but that creates the risk here is how China is dealing with this credit crunch. So let me get to this without any further I do. Okay. Hey, Steve?
Yeah, you can't drive
How
them.
do I advance these slides? Do you know? Event control? Let's see. I'm just not seeing the
Let me see.
panel here. That's that.
If you can't just hit the down arrow at the bottom
There we go.
if you
There we
have
go.
your cursor.
I got it. Can you see that?
No,
Can't see the slides?
no, it's not driving them. Strange. Oh, there you go. Perfect, Jack. Thanks.
Seeing that now?
Yep,
Okay, very good. Sorry about that, everybody.
that's okay. Thank you.
Getting through our disclaimers, and here's the question each day. Kind of we wake up, you know, that whole little thing. What will Jesus do? from a market standpoint, now we ask what will China do today. It really has become the driver. China really, again, the reason is, I mean, they're the big dog in growth and money flow in the world in a very, very big way. The capital gains opportunities from a real asset standpoint have been in China, the commodities driver, the real property investments, and we see a lot of hot money moving into China to get access to these capital gains opportunities. A lot of the big players, the big hedge funds behind the scene, have moved in to get real property investments on the expectation that China will have some type of one-off currency appreciation. That was the dream, I guess, a few years ago. The economists said China's going to increase their currency 20-40% type of thing. And if you had a real property investment, you think of it this way: if you're sitting on something in China, and every time they move their currency upward, automatically your assets move up by the same amount. So a lot of hot money is pulled into China. Additional hot money during these times in which people speculate or rumor that China will increase their currency value. Of course, they've dashed those rumors for many years in here. We saw a lot of these what they're called multi-currency deposits pop up by these different banks, and said, yeah, jump into China and you're going to right away make 20-30% as China appreciates its currency. And you know, people have been sitting in those things for 4 and 5 years and they've gotten zero out of it because they don't pay any interest. So China does what it does to suit itself. And the background in terms of the currency, and again why they haven't listened on this, is their belief that any movement in their currency is going to hammer their overall management of their economy. They're a pure export-driven economy, and they have to make that change, and they are starting to make that change. But they've dug their heels in, and I don't have a chart in here, but one of the reasons China has been so I guess, tight on this currency policy. 2 reasons. Number one, they don't want to float the currency, because if they did, they would have to make their currency exchangeable, and that would allow their citizens to move money outside of China. It would go hand in hand. So they want to still have that control, very tight capital controls. Number one, which doesn't meet the requirements for a floating currency. You can't float a currency unless you remove capital controls. They have not wanted to do that because they still want to control their citizens.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.